Good morning, everyone. We'll get started in just a moment. Thank you for joining us today. David Moore, IRA Advantage. Hope you're having a great start to the day. Well, you guys are here on time. We're not going to hold up for the people that are behind. So we've got a lot of information and little time to get through it. And we're in pretty crazy times right now. And I'm pretty much under the impression most of the people on this call today are real estate brokers. So you're definitely feeling what's going on out there. I was watching something this morning talking about roughly 40% of the houses in today's world are not owner occupied, which is pretty interesting. And I used to sort of falls in line. I was taught in the exchange world by my mentor and friend. Actually, I was talking to him this morning, a guy named Ron Stash. And I asked him what the heck's going on in the world. Everything I thought I knew, I don't. But interesting times, and we always said if we go back into the late 80s, early 90s, you say up to 64% of the properties on the market could or should be exchanged. And obviously with the number that I just gave you, 40%, that definitely falls in line. And that's without the whole idea that you've got lots of homes that it might have after COVID, a home office in them, so on and so forth. So here I am talking about 1031, and today's presentation is on self-directed retirement accounts. So I'm going to shift gears, get into the topic that we're here to talk about today. And I doubt I'll be getting to questions on that side panel. If you are in Oregon and you are a real estate professional, you want CE, please reach out to C Moore, C-M-O-O-R-E at 1031exchange.com, C Moore at 1031exchange.com, and she will get you credit hours for the class today. It's good for one. And my objective is to get you to understand how to use this, understand that it's not new, understand the basic do's and don'ts. And I like to keep it simple, the old KISS principle. I've got an old buddy that used to work with me in here, JC Kutnikoff. Those of you out there that know him know he's a neat guy, and he always really loved that KISS principle. So that's what we're going to talk about. And I'm just going to hit you with that real quick, actually, because 1031s, if we're looking at a 1031 exchange, there's four basic things that have to happen within the exchange. One, it's got to be an exchange. So if you close something, it's too late. You can't own the new and old at the same time. You've got to literally give something away to be given something back. And an exchange in today's world is a three-way exchange. You're paying a facilitator to step into the middle of the transaction, take your sale and purchase, and turn it into an exchange. So you're giving away something to be given something back. What's going to receive has got to be of like kind. To be totally tax deferred in 1031 is not all or nothing. You need to go across or up in value and equity. And once again, for the real estate professionals on this call, understand that one of the big fallacies at 1031 is you have to replace debt. Well, what happens in a recessionary time? You've got a reduced loan to value that's available through the financial world. Typically, you might have a reduction in what your equity is, because maybe the property's eroded a little bit in value, and you've got reduced income. Typically, you've got a variety of things going on. So it's common for people to have to add money to a transaction on the acquisition. And I'm just going to tell you, debt in a exchange can go away two ways. One, by going down in value, triggers taxes. You went down in value. The other way debt goes away is by adding cash, which is always fine. So somebody might tell you, well, gee, if you don't want any debt on the replacement, you've got to pay off the relinquished before it goes away. That's not necessary. You don't have to do that. You're just going to show up at the acquisition, the replacement with the additional money. So one, it's an exchange. Two, it's given, received, or like kind. Three, in order to be totally tax deferred, you're going across or up in value and equity, and it's not all or nothing. So every dollar you spend over your basis represents tax deferred gain. And then finally, we've got to have continuity of vesting. And for those of you that have done exchanges, the biggest headache's always going to be time. Second biggest is going to be vesting. The taxpayer that relinquishes has to receive. Now, I'm going to hit you with two rules for retirement accounts. And you say, well, gee, hey, I've got 55 minutes left. Don't have to watch the rest. And if you look at retirement accounts, two issues are what's important. One, what are you investing in? And unless it's specifically prohibited, it's therefore allowed. That's the way the world works with investments and retirement accounts. Unless it's specifically prohibited, it's therefore allowed. So with an IRA, you can buy literally anything other than collectibles, life insurance contracts, or stock and sub S corp. The rules have never changed on this, so it's always been possible to do this stuff. So one, what do you want to buy? And by the way, 401k plans, the only restriction on investment is you cannot buy invest in collectibles. So what are you going to buy and who are you transacting between or for the benefit of? Rarely is the investment a problem. What causes problems for people is transactions between or for the benefit of a disqualified party, which we will talk about in a little bit. So no such thing as dumb question. The dumb question is the one you don't ask. In this world, it's critical that you plan ahead. You know, if you know how to scuba dive, the golden rule is plan the dive, dive the plan. If you're a pilot, you're going to fly, file a flight plan. Even big boats, you got to figure out where you're going to go, set that plan in motion. You're going to go do it. Let people know what's going on. So in real estate, it's really if you're going to be buying real estate, obviously it's critical. Real estate's not an easy investment. You've got to be planning ahead to take care of that. Most of the time, people come to us because they want to take their IRAs, 401k plans, and buy more, let's say, real estate, because that's our background. The other thing lots of people are doing is they're investing in notes. You can buy from different investment companies. You can actually buy paper. There's a company that actually will package. They've got a hard money investment fund you can do. But lots of people are making loans, buying notes with their retirement accounts. I've got builders that have figured out they're tired of dealing with the red tape of the banks, and so they put investment funds together and they actually self-fund their projects. So it's a pretty neat deal. These things are all possible. Self-directed accounts have been available since the inception of IRAs and 401k plans in the mid-70s. So this stuff is not new. It's just a very well-kept secret. So today's title, invest in what you want when you want. I mean, the reality is you've got a very, very large menu of investment options, and the biggest obstruction to making those investments is just the lack of information that's out there on how to get it done. And for the most part, we're just simply going to create a custodial account that allows a self-directed investment. That's brick number one. And then from there, depending on what type of investments, the time sensitivity of it, management requirements, so on and so forth, we might do what's called a checkbook IRA. If you're self-employed without employees, we're probably going to do a solo 401k plan for you. If you said, David, gee, I've lost my job, quit my job, I want to do something else, I want to go create a new business, and I want to use my retirement account, do that, that's possible. It's called a rollover business startup. The acronym is ROBS. But there's all of these options out there that people just are not aware of, and it's because I think that a lot of times Wall Street looks at the money as theirs, and it's yours, it's your retirement, it's your money, and we like to say invest in what you know, invest in what you want, and take advantage of that stuff. Now, a good friend used to talk about your ability to invest in what you know. If you've got specific knowledge of things in Wall Street, you can't legally use that information. Ask Martha Stewart about that. But if you look at a piece of real estate or you do a self-directed account, you want to go out and you're a real estate broker or a mortgage broker, something like that, you're a mortgage broker, you want to make loans with your retirement account, you can do that. You're a real estate broker, or hopefully you've got some additional ability to make good investments through what you do as a profession. Well, you can do that. You get to take advantage of that knowledge. And that's one of the most powerful things about the self-directed accounts is your ability to literally invest in what you want to do it and when you want to do it, and you can invest in what you know. So hopefully you're reducing risk and putting yourself in a much better spot to live in retirement the way you want to live. All right, click, there we go. This is funny. Look at the date on this. This is back to March 2nd, 2012, and this is a comment made actually in the Wall Street Journal, IRAs get sexier. And it was really just talking about people's ability. And back to my comment on 40% of homes are owned by investors these days. But if you talk to a financial advisor about taking your money, going out and investing in real estate, typically you're going to be pointed towards a real estate investment trust, which, yes, that you're making an investment into a stock that owns real estate. So maybe you get some of the stability the real estate might offer you, but you don't own real estate. And if you're in a 1031 context, you cannot exchange into a REIT or out of a REIT into or out of a piece of real property. So there is a way to get you there. It's called something called a 721 UPREIT. You're basically going to exchange into a Delaware statutory trust that rolls into the shares of that REIT. So it's possible to get you there. It's a great end game. It's I think the ultimate installment sale. But REITs are not real estate. REITs a stock that it's just a stock that with a firm that owns a bunch of real estate assets. So when you're looking at diversification, looking at what you want to do with your retirement accounts, you can go out and buy a rental house, you can buy land, you can buy apartment buildings, you can buy all of those things. You can buy any real property that's not going to be used or by a disqualified party, which, as I said, we're going to talk about that a little bit further in a few minutes. So this is not new. Once again, it's been around forever, and I just love that headline. IRAs get sexier. Bottom line, any IRA can be self-directed. So any IRA can be self-directed. If we're talking about a current employer plan, if you've got a 401k plan and it's with your current employer and you're under 59.5, the money's stuck. At 59.5, you can take in-service distributions, previous employer plans. We can typically roll those into a self-directed IRA. And depending on, once again, what you do for a living and your employer-employee situation, I really like solo 401k plans. We're going to talk about them in a little while. So any IRA can be self-directed. With respect to other company plans, it really depends on if it's the current or previous employer plan and your age. That's going to dictate what your options are. Now, it's interesting because I've actually had people step away from their businesses to get access to their funds. Going into the last crash, I had somebody working for a major corporation, and this guy was very concerned about the market. And he said, look, if the market tanks, I don't have 10 years ahead of me to make back what I have. And he literally quit his job because that retirement account wouldn't allow him to go to cash, and he was concerned about the market. So it's really important for you to understand what your options are. And if you're changing jobs, I would really contemplate, instead of rolling your plan from the old employer to the new employer, to really consider moving from that 401k plan into an IRA at that point, whether it's self-directed or not, because at least that way you've got control of the thing instead of having it in some other corporation's retirement account. But very easy to put these things together. And before, if I go back the late 90s and early 2000s, and before we were in this business and looking at what opportunities we were able to unlock for our people, because our clients kept coming to us, say, hey, we've heard we can do this, how do we do it? And I'd go to a class on it, I'd walk out at the end of the day, and typically the classes were being offered by somebody that's offering investments. So I would learn how to make the investment what they were selling me, but I didn't really get out of there understanding what was involved with making the investment. And all these years later, I look at it with a totally different set of glasses on, and it's really just it's as simple as moving the funds you want to use in this capacity. If we're talking about an IRA from custodian A to custodian B, and it's not all or nothing. Just as I said in 1031s, it's not an all or nothing proposition. In this world, it's the same situation. I would keep your Wall Street money where it is with the advisors you've been working with and that you like to work with, and I would only move what you want to move to make self-directed investments into that new account. And that's for a variety of reasons, which we'll get to in a little while. But I want to stress this fact, it's not all or nothing, and there's good reasons when we're talking about IRAs to keep that money in different accounts, keep it segregated. 401k plans, it's not necessary because we've got different repercussions of a prohibited transaction, which we'll talk about in a few minutes. So everything you need to know, I told you earlier. So if we're looking at 1031s, I got those 4 issues. It's an exchange, what's going to receive your like kind. You go across, you're up in value and equity, and you've got to have continuity investing. If we're looking at the retirement accounts, you got 2 simple questions to qualify any investment. What do you want to invest in? and who are you transacting between or for the benefit of? And that's really what it comes down to. And you know, we're going to talk about sort of fallacies of the IRA 401k investment world in a few minutes, but I mean, it really boils down to these two things. And then as far as possible investments with an IRA, it's anything other than collectibles, life insurance contracts, or stock and sub S corp. 401k plans can literally buy anything other than collectibles. So rarely is that investment going to be an issue. The issue that typically comes up and causes problems for people is transactions between or for the benefit of a disqualified party. And you're going, David, you know, who's a disqualified party to my plan? Well, you're a disqualified party to your plan. If you're married, your spouse is a disqualified party to your plan. Well, if you've got a traditional and a Roth IRA, those two accounts are disqualified parties to one another. So typically, though, we're looking at lineal ascendants, descendants, their spouses, or any legal entity owned in the controlling interest by one of those. Those are the people that we're typically worried about. But if we want to aggregate a variety of different let's say, disqualified parties into a common investment, that's possible. So you can transact along with a disqualified party, you just can't transact between or for the benefit of. So if you want to combine personal money and plan money in a common property or common note or whatever it might be, that's possible. We just have to structure it correctly. Even if you're combining, let's say, traditional and Roth money into traditional IRA and Roth money into a single investment, that's possible. Even though those two accounts are disqualified parties to one another, we've just got to plan ahead and make sure we're doing it correctly from the beginning. So why a self-directed retirement account? Well, you know, a variety of reasons. These are the most popular ones. One, people are tired of the stock market's roller coaster, right? And what, you know, why is it a roller coaster? Well, it has to do with liquidity, right? I mean, if you want to sell a stock, you call up and you do it. Or if you got an online service, you're going to just do it that way. You just hit sell or hit buy or whatever it might be. Now, real estate's not that easy. It's not considered a liquid asset. Now, in recessionary times, I'm going to tell you, tangible assets are always considered to be inflationary hedges. Hard assets are typically, even though they're considered alternative investments, I mean, they're the oldest investments known to mankind. So, you know, if we look at why people do these accounts, you know, one, they're tired of the ups and downs of Wall Street. Maybe they want greater financial control. You're not with real estate. You're not betting that thing's going to go up. And I always joke, I'm in the business selling real estate to real estate people. But you're not betting it's going to go up in value. You've got somebody else paying the debt service for it. You've got somebody else that's working, you know, in that thing, taking care of it. You know, the hard thing about real estate is you do have to take care of it. It's not an easy thing. But you know, the downside of owning things with a retirement account as far as real estate, if you're comparing, you know, people might say, well, gee, you know, why would you buy real estate with an IRA when you're going to lose long-term capital gains tax rates or interest deductions? Well, you know, that's true, but there's nothing you're going to buy with a retirement account that gives you those things. So it's really sort of a moot point. But you know, if we look at this set of little bullets, it's, you know, one, tired of the stock market's roller coaster, greater financial control, invest in what you know. We talked about that. Increased investment flexibility. Why wouldn't you want an account that allows you to buy literally anything you want versus being stuck in something that maybe you don't know as well? Or why not have that ability to diversify? I mean, that's really the secret of success in financial investments, right? Is having some diversity of investment options. So increased investment, like I said, real estate investments, not alternative investments. The whole alternative investment thing drives me crazy. I mean, anything that's a hard asset's considered an alternative investment. You can go buy precious metals, alternative investment. Real estate, alternative investment, and you know, name something that's older, more time tested than real estate or you know, metals really over time. But metals, you're betting it's going to go up in value, where the real estate you're not. Community-based investing. You want to do something locally, you can do that. I mean, that's not a problem. So you want to make a difference in your community by making loans with your retirement account, do it. You can make those community-based investing decisions, and that's going to be just fine instead of just handing the stuff off to Wall Street. Today's opportunities, you know, with a truly self-directed account, you can make the investment you want, when you want, as you want. I mean, you can literally do it with a checkbook IRA solo 401k by writing a check. I mean, so it's really easy to make those investments as you want. As I said, tangible assets, great hedges against inflation. Security, what do I mean about security? By security, I guess I should say. Well, your money is, if you've got a regular Wall Street IRA, the money's where it is, right? I mean, it's with whatever investment firm it is, it's in whatever accounts it is, wherever it is. And if you've got a self-directed account, a 401k plan, a roller business startup, a checkbook IRA, the money's literally sitting in the institution that you pick. And so if you want to put it in your local regional bank, you can do that. That's where your account is. With a checkbook IRA, you're just going to have a bank account in the LLC's name and EIN, federal tax ID number, and you are typically going to be, the manager of that LLC. The member is a trust company for benefit of your IRA. If you've got a solo 401k plan, you can have a bank account, the plan's name and EIN. You're the trustee of the plan. You've got the signing ability, and you've got the ability to make, buy, sell whatever investment you want as you want to do that. A rollover business startup, we're typically talking about a bank account for the plan and a bank account for the corporation. But these things it's easy to put the money where you want to put it. So that's the security comment. You're working with people that in the region, doing what you want, when you want, as you want. Common objections. So you go and you talk to your financial advisor, your tax people, and I'm really convinced that a lot of the CE, continuing education for the tax and legal community, is by Wall Street when it comes to this stuff, because these are common objections. I've got different companies. If I get a call to put a retirement account together from, and I find out that their current trust company is ABC Trust, I know what their objections are going to be over time. And typically, like I said, one of the biggest objections by a financial advisor for you to self-direct your account is, well, gee, why do that? You lose long-term capital gains tax rate. Well, as I said, and you're going to lose interest deductions, depreciation, as I said in this fourth bullet down the bottom. But the long-term capital gains tax rate, comment, if you're arguing that you're better off pulling money out of your pocket to go buy the property versus using qualified money to do that, yes, that's true. But really, that's not the question. The question really should be, what's the highest best use for the funds in your retirement account? What's the highest best use? What's going to be the safest investment? And why not invest in what you know and use those things? So the fact that if you pull money out of your pocket, go buy real estate, and you hold it for, let's say, a year or more, and you've held it for investment, you sell it, you're going to pay a long-term capital gains tax rate, not normal income tax. The other thing, you've got the ability to do a 1031 exchange. And if you look at the IRA, and really 1031, I would argue, is just an IRA or 401k for real estate. So if we look at Wall Street stuff, you've got, with IRAs and 401ks, you've got an automatic rollover of gain tax deferral just through the investment vehicle itself. But anything you use, so a traditional IRA is pre-tax money growing tax deferred. A Roth IRA is tax money that grows tax free. So the idea that, well, gee, you shouldn't take your IRA to go buy real estate is because of the loss of long-term capital gains tax rates is pointless, because there's nothing you're going to buy with a retirement account that gives you long-term capital gains tax rate. And really solely a question of what's going to be the best, safest investment for you. That's what should be driving that. So number one, true, but it's a moot point because it really impacts anything and everything. You got a retirement account. Cannot be leveraged. Totally wrong. You can leverage an IRA-owned piece of property or a 401k-owned piece of property. It's got to be non-recourse debt. We'll talk about that in a few minutes, but in a nutshell, you're looking at a loan that's not recourse to you in any way. So it's not going to be attributable to your credit or anything else you got going on. The only thing that lender can do is take the asset in a foreclosure. They can't go after anything you have. They can't go after anything else that the retirement account owns. Okay, so to say you can't leverage an IRA-owned asset is totally incorrect. You just got to understand it's got to be non-recourse debt. And we've got some other topics or issues we're going to talk about with respect to that in a few minutes. RMDs, required minimum distributions. Now, remember I said, that lack of liquidity is considered a problem when we're looking at IRA or 401k owned assets. What happens if you get to an age where you got to take an RMD, required minimum distribution, and there's no money to do it? Well, Take an in-kind distribution. Well, David, what's that? Well, in kind, there's nothing that states you've got to take a cash distribution. So a lot of our clients will buy something ultimately they would like to own. You want to go buy a rental house at the beach, the retirement into at some point. That's possible. You nor any other disqualified party can use it in any way until it's been taken fully out as a distribution. But you can take that property as a distribution. Even better, you can take pieces of the property as a distribution. And what Wall Street points as is potentially a problem, I would say is quite possibly the best thing going about taking in-kind distributions is one, if you have to take a cash distribution, cash is cash. It is what it is. You sell the shares of the stock, you know what's going on there. Real estate, once again, what's a piece of property worth? It's its highest best use. And if you've got buyer or seller agreeing a price, then obviously you know what it is. But if there's no sale pending, what is a piece of property worth? So you've got a valuation situation there that has some potential ups or downs. The second huge benefit is of taking a fractional interest. If you take a minority interest distribution of a piece of property, you can discount the value of what you take as a distribution if it's a minority interest by up to 40%. Now that's a huge benefit there. So, once again, I'm going to say that not only are you not trapped if you don't have cash there, but if you want to take an in-kind distribution, just do it. And there's many, many reasons to do that thing. So don't be afraid of that. It's a big opportunity. And then finally, we've got, obviously, if your IRA owns a property, you don't own it. And what I'm going to tell you right now is the way I want you to think about any retirement account investment. It's not you. You do not own that investment. So if your IRA buys an apartment building, all the cash flow of that apartment building is the IRA's. If there's a tax liability to that investment, it's the IRA's. It's not yours. You do not own it. You can manage the asset, but there's absolutely no way you should get any benefit and burden of ownership. If you do, it's a prohibited transaction. A prohibited transaction is an ugly deal, which we'll talk about in a few minutes. All right, so whatever it owns, you do not think of it that way. I always like to say, well, it's Susie. Don't think of it as you. It's Susie down the street. You're not going to take her money. You're not going to pay for her stuff. You're not going to work on her stuff. You're not going to be a guarantor for her stuff. It's hers, right? So the only time it becomes you and yours is when you take these things as a distribution at the end of the day. Otherwise, it's in there until it's not. So, and what I mean by that is, everything's inside an account. We're not taking money out of an IRA to go buy these things. We're just merely moving from custodian A to custodian B. It's in your IRA. It's in your retirement account. It's in the 401k plan until you take these things out as a distribution. Possible investments. Pretty much covered this one in depth already, but anything other than collectibles, life insurance contracts, or stock in a sub S corp, you name it, an IRA can probably purchase it. It just needs to be simply for investment purposes. 401k plans can buy anything other than collectibles, so they're even more liberal. So once again, the investment's rarely the problem. What causes problems is transactions between or for the benefit of disqualified party. Who's a disqualified party? Well, individual members of your family, spouse, ancestor, lineal descendant, and any spouse of a lineal descendant or ascendant for that matter. You can manage an asset. You cannot be working on property. Sweat equity is not okay. As far as you're concerned, like I said, with debt, it's all going to be dependent upon the property and what's going on with the property. And you've got to be aware of that, if you're looking at a loan for an IRA, you're going to be looking at a lower loan to value, maybe 60, 65% at most. They're going to want to see 15% reserves there. And they're going to want to see that you have some experience with investment real estate, because if there is a problem with it, you can't just feed that thing. The property has to float itself, and that loan is going to be serviced by that retirement account. So you really have to plan ahead, take care of the stuff. And as I mentioned earlier about pilots or divers or mariners, you really need to understand when you're putting these things together, you've got enough money in this thing to make the investment cover any carrying costs until things are cash flow and get you where you want to go. So, you know, once again, I want to stress you can't transact between or for the benefit of disqualified party, but you can transact along with a disqualified party. So we can go out and be a common owner, and that's, you know, that's the great way of looking at it. So common examples of prohibited transactions would be assignment of a purchase sale agreement. So if you tie up a property, and this is the deal. Okay, you want to make sure that if you're considering, let's say, buying a piece of property with the IRA, get the investment vehicle set up first, because in today's world, I mean, you know, I didn't know if I should laugh or cry. I was reading an article this morning about it. You know, people bored in the workplace. You know, the employees not wanting to work. Well, things happen slow. Just getting people to, you know, to work is one thing, and having them do their deal is another. And then, you know, throw into the mix that when you call a trust company or, you know, big institution today, how long does it take to just merely talk to somebody? So the fastest we've ever put a checkbook IRA together, I think, is inside a week. But in today's world, we're probably going to tell you it's going to take you a month to get it all done. And it's just because it takes time to move the money from custodian A to custodian B. If we're talking about a checkbook IRA, it goes from custodian A to custodian B. Custodian B then makes an investment in an LLC, which funds a bank account that we've, you know, created. So we got to create the LLC, get the information to you, you open the bank account, and we just got to get money moved all around. So it takes time to get these things taken care of. So even though a purchase sale agreement is assignable, typically, we don't want you to personally tie it up and then assign it over to your plan, because you have taken the property off the market. It can be argued that there's a benefit to your retirement account by the fact you took it off the market. So if you find the perfect investment before your account's set up, I'm going to tell you, you know, have a sibling put that thing together, make the offer. Now, I apologize, on the disqualified party page, I didn't mention, and you might not have noticed, well, it didn't say anything about siblings or aunts, uncles, or cousins. Okay, so siblings are not disqualified parties to your retirement account, nor are your aunts, uncles, or cousins. So if you have an investment you want to make, the account's not set up yet, have your brother or sister make the offer and tie it up, and then they can assign it over. But, you know, if you or any other disqualified party ties up the property and then assigns it over, that could be considered a prohibited transaction, which would torpedo your entire account. So it's really important you get things set up early rather than late. Recourse debt, that's one of the big problems. And even if you're a co-owner of the property, you can't say, well, gee, the IRA owned component is non-recourse. It's just recourse for me for my portion, you know, tenancy in common. Well, that doesn't work, because you're getting a loan because you allowed recourse to you on your portion, which constitutes a prohibited transaction. So you cannot allow recourse debt, period. Contributions or distributions directly between the IRA, LLC, and account owner. So this is something that happens because what happens with a checkbook IRA, once again, we're creating a custodial account, we're creating that IRA specific limited liability company, and then you want to make an additional contribution, and so you write a check directly to the LLC. That's a prohibited transaction. Your contribution would go to the trust company. The trust company then makes an additional investment in the LLC. You want to take a distribution. Once again, the money's going to flow from the LLC through the trust company and out. So any in or out of that LLC has to flow through that trust company. It just takes time, and so inevitably somebody will make a direct contribution or a distribution, and either way that would constitute a prohibited transaction. Working on an IRA-owned asset. So I said earlier, I said you can manage an asset, you cannot get dirty on it. So working on the property, you want to go out and wield a hammer or pull a paintbrush out, you shouldn't do it. That's a prohibited transaction. And you might say, well, gee, and you look at it and you say, what rational reason does the government have to prohibit a sweat equity in an investment? Because really what sweat equity does is increases the value of the account without a corresponding expense, therefore increases the value of the account, which ultimately converts to more taxes for the government at some point upon a distribution. Because remember, everything that's in it has to come out at some point, and it's all normal income tax coming out. So the only rational reason I can see that they prohibited that is that they are foregoing the tax revenue generated by the people working on your property for the promise of getting the stuff way down the road, and they don't want that to happen. So once again, sweat equity is not okay. using the IRA-owned asset in any way is not okay. You can't go buy a condo for mom to live in, junior to live in while junior's in school, or any of those things. You cannot buy a property, some vacation area, and use it. Even if you're working on the property, which I said you shouldn't be, because sweat equity is not okay. And by the way, you're not going to write off trips to this property either, because it's not yours. It's the retirement account. So I want to stress that again, that going and working on the property is not okay. Writing off the trip to go check on the property is not okay, because it's not you, it's not yours, it's your IRAs. So just be aware of those things. All around, it's Susie's, it's not yours. Buying from or selling to a disqualified party is not okay. To buy a property for your business to occupy using your retirement account, that's not okay if you own a controlling interest in that business. So use of another common prohibited transaction would be to buy a property with your IRA or 401k and just add that asset as an additional insured asset on your homeowner's policy. It's not you, once again, it's your retirement account. So it needs to have its own account to take care of that stuff. The big thing about any of these prohibited transactions is that with an IRA, it's not the money involved in the indiscretion that's a problem. It's that it converts the entire account as of the first day in the year in which the indiscretion occurs, which that's a huge problem. So you don't want to commit a prohibited transaction because all funds in the account are treated as distributed. And that's why I made the comment earlier about it's not an all or nothing choice. Keep your Wall Street stuff with your Wall Street people. Move what you want to use in this capacity into the self-directed account. That way you've isolated those accounts and protected things. Now with a 401k plan, repercussions of prohibited transaction are totally different. It's only the money involved with the indiscretion that's treated as a distribution. So totally different scenario when we're talking about 401k plans versus IRAs. Few questions that I get asked all the time. Can I work on the property? We've talked about that. The answer is no. You can manage the asset. You cannot work on it. Sweat equity is not allowed. Can I guarantee a loan for my retirement account? Once again, no, you cannot do that, because that would you'd be creating a benefit to a disqualified party, which constitutes a prohibited transaction. Can my business occupy a building owned by my retirement account? The answer, once again, is no. And this is a question that for some reason comes up all the time. I've got lawyers that call me up wanting to do this. I've got doctors that call up wanting to do this, and you cannot do that. Can I write off expense for travel, etc.? As I said on the previous slide, the answer is no, you can't. It's not yours. It's legally speaking, if we're talking about an IRA, you're looking at an LLC that owns the asset. The member of the LLC is a trust company. It's not you. You're the manager of that LLC, but you're not even a member of the LLC. So in no way is it yours, and therefore it's not something that you're able to write off. And even if you were to be able to write it off, it's something that definitely constitutes a prohibited transaction. What real estate qualifies? Okay, rental houses, apartment buildings, office buildings, retail centers, land, any property to be held for investment, a future retirement home is possible. You just cannot use that thing at all until it's taken as a distribution. Cannot buy a primary residence, cannot buy a second home, cannot buy home for a disqualified party, and you cannot buy an office building to be used by a disqualified party. So establishing, how do we do this? And as I said, I'd go to these classes and I'd spend all day there and I wouldn't learn how to do it. And so, when you're looking at these things, it's very simple to do it. And if you're making an investment, a single investment that's not time sensitive, and we're talking in an IRA context, a basic self-directed IRA would satisfy your investment needs. Now, David, what's a basic self-directed IRA? And all we're really doing is moving the money that you want to use from trust company A that won't allow you to do what you want to trust company B that will allow you to. So, and that's a very important point to make. If you've got and this whole term self-directed drives me crazy, because if I give a presentation in person, and it's great to have you guys online. I like sitting in a room with everybody and interacting with you. I'd prefer to do that. If I were in the room with you guys and I asked, gee, who in the room's got a self-directed account, I'd see a half dozen hands go up. I know that maybe a couple of you have worked with us and you truly have a self-directed a retirement account, but the balance of you are going to have what a major Wall Street firm considers self-directed account, which is one that allows you to buy what you want when you want from their menu of investment options, but it's not truly self-directed. A truly self-directed account is an account that's going to allow you to buy anything the law allows. So if you've got an IRA that doesn't allow you to do that today, it's not by law, it's by that trust company, that IRA's that trust company or custodian's rules. It's nothing to do with what the law says with respect to what an IRA can buy. If you've got a 401k plan that doesn't allow you to make the investment you want to make today, it's either due to the plan document or the administrator, the trustees, not allowing you to do it. It's not by law, once again, because if the plan doesn't allow it, and really, to be honest with you, a lot of times the plan allows the investment that the trustee or administrator doesn't even know what that plan allows them people to buy until you point out these things. But if the plan doesn't allow it, the easy solution is amend the plan to allow it. If you can't amend the plan to allow it, you replace the plan. But the bigger issue really is the TPA, third party administrator, who's managing the thing, whether they're going to allow you to make those investments, and that's going to be the bigger issue. But once again, it's not a legal issue. It's just an issue that comes up due to either the plan document or the people that are running that thing for you, the administrator or that trustee. So if we're looking at establishing a basic self-directed IRA, it's really simple. You can go to any number of trust companies online, and you can do it online. You can fill out a form online, and you can establish that custodial account. You don't need us to do that. If you want a checkbook IRA or IRA LLC, then the trust companies are not going to do that component for you. But if we're looking at putting a basic account together, if you're working with us, if you want us to do it, we have lots of people that will pay us to establish even a basic account, and you're paying us a few $100 to put that together for you. And as I said, you don't need us to do it. But really, if you're working with us, we're going to want a copy of your current account's most recent statement. We're going to want a copy of a photo ID. We're going to have you fill out a 2-page form, which basically is asking you information about you. And then if we're doing a checkbook IRA, we're going to want to know some potential names for the LLC and states of registration. And then we're going to take that information and fill out a variety of forms. One of them is a transfer authorization form, which allows the new trust company to go to the old trust company and say, give me the money. And really, that's going to establish that custodial account. And then to make an investment with a basic account, you're going to have to submit the investment to the trust company. You're going to fill out a prohibited transaction form. You're going to fill out information on the investment itself, anything to do, any documentation for that investment, submit it all to the trust company. Upon their approval, they're going to make the investment for you. So, in the Wall Street world, it's virtually impossible to commit a prohibited transaction. You make a prohibited transaction, you make a poor investment, but you're not going to have a situation where you're able to really commit a prohibited transaction. In a basic self-directed IRA, once again, you've got that trust company sort of as a safety net to protect you from committing a prohibited transaction. If you've got a checkbook IRA, IRA LLC or solo 401k, really it's up to you to really stay within the lines on this thing, make sure you're doing the right thing. And I'm going to go to the next slide real quick because we're talking about checkbook IRAs. So when we're looking at a checkbook IRA, and this is what's important, we're creating that basic custodial account like we would just for a basic account. We're still doing that, but instead of instructing the trust company to make the ultimate investment, what's happened is we are creating that IRA specific limited liability company and inserting it between the trust company and the ultimate investment. So as the money and as the account's being established, as the money's moving from trust company A to trust company B, we will have created the limited liability company. And when you're naming that, and this is where I was going with the last slide, We even take it down to naming of the LLC. I mean, inevitably, if you're, Tom Jones and we're putting a checkbook IRA together, you might say, well, gee, I want to name the IRA LLC, Jones LLC. And I'm going to tell you, don't. I'm going to say, let's come up with a name that anytime you look at that name, you are painfully aware it's not you, that it's your IRA, and therefore by that, making it that obvious that it's not you, then you're going to be much more aware of what's going on. And anytime you pull out that checkbook, you're going to think, okay, what am I writing this check for, and who is it for? Whether it's for an investment or maintaining a property or whatever it might be, you got to get yourself in that mindset that retirement account is not you. So you might say, David, gee, I want to go out buy the apartment building with my IRA because I need more cash flow. I'm going to say, okay, fine, we can create the account that allows you to buy that apartment building, but the only way you're getting cash flow off it is for the cash flow to build up inside the IRA LLC or in the 401k plan, and then you end up taking a distribution of that money as you want or need to do that. Now, that's how you get the benefit of those investments, but you're not the owner of the property. You cannot just take things out of that IRA LLC directly to you without it constituting a prohibited transaction. And whether somebody's talking to you about non-recourse debt and you being a guarantor on the loan, whatever it is, it's not you. So when we've created that checkbook IRA, it's just one additional step that we're doing that makes the rest of your life easy. And so we're creating that basic custodial account, and instead of having the custodian buying and selling whatever from that point forward, the custodian's making one investment for you, and that investment they're making is in the membership interest of that LLC that you have opened a bank account for at the bank of your choice. You are the manager of that limited liability company. The trust company is a member of that limited liability company. And by the way, we could have that IRA LLC could have your traditional and Roth accounts in it, could have your account and your spouse's account. It could have your personal money and plan money in it too. All these things are possible when we're forming this thing. But if we create the IRA LLC and it's multi-member and the members are disqualified parties, we want to overfund that initial investment, because additional money coming in from a disqualified source in the future could constitute a prohibited transaction. So you want to make sure you say, gee, David, I need $200,000 to buy this piece of property. I'm going to say, let's put 240 in it or something like that. So you've got the money there just in case something, maybe it needs a new roof, maybe somebody beats the thing up, maybe something happens, you buy in Portland and all of a sudden you're in a state, in a city where the powers to be have said, well, gee, the tenants don't have to pay it. Just be prepared for that stuff so you're not trapped in that situation and having to find a solution. Now, if you do have a hardship you come into, that's why we're here. You give us a call, talk to us about it, and hopefully we can find a solution for you. So, when you're looking at a transaction and figuring out what you're doing, all custodians are not, made the same way. I'm going to tell you, when you're looking at custodian, one, you want to work with a custodian or trust company that's been in the business for a while. Two, I'm really fundamentally opposed to trust companies charging you based upon the value of your account. Now, it's one thing for you to be charged that way in Wall Street because you got stated valuations and it is what it is. But when you're talking about buying crypto, or you're buying real estate, or you're buying notes or making loans, what are these things worth? And if you're sitting there fighting the trust company over valuation, that's not fun. So I really believe that in the self-directed world, you don't want to be working with a trust company charging you based upon the value of the account. So the trust company that we typically use charges you based upon the number of investments. Well, with a basic account, that's important, because with a basic account, that trust company is the owner of each investment. If we're talking about a checkbook IRA, the trust company makes one investment, the IRA LLC's membership interest. That LLC could own 50 properties, but in the trust company's eyes, it's one. So it's really important to understand, not just what they're charging, but how they charge you, and really work with a situation where it's not going to cause you a problem, or have you in a situation where you're arguing with them over valuations of what's going on there. But if you're buying, if you want immediacy of investment, or you want to be the manager of this thing, it's really going to require a checkbook IRA. And this process, this structure has been around since the Swanson case sort of ratified in 1996. So once again, it's not new, but it's something that is a well-kept secret. And this is what most of the time people are going to use if like I said, if they're buying real estate, especially if they're going to be, let's say, buying an auction-owned REO property, bank-owned property, those type of things where you need immediacy of investment. You've got literally to go out and buy a property with the IRA LLC. You're just going to negotiate the purchase in the LLC's name and EIN, and the U.S. manager are going to be signing the documents. You need money, you're writing a check. So it works great. And then as things sell, it just goes back in the LLC and sits there until you make the next investment. So they really work great. So I sort of got ahead on this one, but who and what can be members of the LLC? As I said, you can have any number of members in the IRA LLC, whether they're different retirement accounts or you and a retirement account. So you can even have disqualified parties in there too. It's just that it needs to be structured correctly at inception. And this is why you really look at what you're doing, understand where you are and where you want to be 2, 5, 10 years, and you make sure you structure these things in advance and understand what is possible, what you can and can't do before you go and jump into this. And if you're a real estate broker, by the way, I really want to stress this. If somebody comes to you and says, well, gee, I wish I had money to go buy this or that property or buy these notes, and you can throw out there, well, maybe if you've got a retirement account, maybe you got it there. But if somebody comes to you and says, gee, I want to go write this offer, your first question is going to be, is the account ready to make that offer? Do they have a self-direct account in place, ready to go? Because you're going to need earnest money, and just who has the power of the pen to make an offer in the first place? So it's really ideal that the account is set. Now, if they've got a basic self-direct IRA, you're writing the offer between whom? The seller, and in a basic account, the legal owner is going to be the trust company for benefit of that person's IRA. Who has the power of the pen for that trust company? Your investor doesn't. So it's really important with a basic account. It's going to be a lot more cumbersome. Now with a checkbook IRA, you're simply making an offer in the LLC's name and EIN, and your investor is the manager of that. Well, the investor, I should correct it, is legally speaking the retirement account, but you're working with the manager of the LLC that's owner of that IRA 401k plan. So they've got the power of the pen with a solo 401k or a checkbook IRA. You just write in the offer between the seller and the IRA LLC with a checkbook IRA, or between the seller and a solo 401k plan if we're talking about 401k plans. And by the way, the 401k plan can have an LLC too if you want to do that. If you're self-employed without employees, we're doing solo 401k and you still want an LLC, that's fine. Just like a checkbook IRA has the trust company as its member, we just do a new LLC with a 401k plan as its member. So that's totally fine. If you want that, we can take care of it. So anyway. Recourse, non-recourse loans. So can you get a loan? Yes, it's got to be non-recourse. Loan must be non-recourse, period. You cannot personally guarantee a loan on that is to your retirement account, nor can any other disqualified party guarantee that loan. And as far as something that's really important for people to understand with IRAs is that there's something called unrelated business taxable income, UBTI or UBIT. Once in a while, it's mentioned that. And basically, you're going to be subject to UBIT in two situations, typically with real estate. One, if you make an investment that's leveraged, any income and gain that's attributable to other people's money, the loan. So if it's 50% loan to value with an IRA, you're going to have tax exposure. I shouldn't say you. The retirement account has tax exposure on half the income and half the gain upon a sale. So there are actually situations where an IRA would have to do an exchange. Even a Roth IRA might have to do a 1031 exchange. So just be aware of that. So once again, with IRAs, even a Roth IRA, you're going to have tax exposure on the income or gain attributable to other people's money. Now, a 401k plan, you don't have that. So it's a totally different situation. David, why is it different for a 401k? Some senator had the 401k plan. The other situation, you're going to have you're going to be subject to UBIT on with an IRA-owned asset is if you're flipping properties. Lots of times people call up, they want to flip properties. So number one problem with flipping properties is a lot of you that flip properties, you work on the property. You can't do that because that would be a prohibited transaction. So you cannot work on properties that your IRA or 401k owns where you're flipping it. Number two, that's not an investment. It's a business. And this is a situation where I argue this all the time with my 1031 clients. You know, flipping property is not an investment, it's a business. So the problem with money out of your pocket doing it, you're paying normal income tax no matter how long it takes you to do the improvements and turn this thing. And two, you don't have the ability to do an exchange on it. So be aware of that. Now, in the IRA 401k world, don't think you got the silver bullet because, you know, one, once again, you can't work on it. It's prohibited transaction. And two, you're conducting business for this thing. So that UBIT situation comes up if you're flipping properties. So just know that. And you know, the tax on leverage is not a reason to do or to make or not make a given investment. It's just another situation that you've got to look at and understand. Your ultimate return on investment is going to be the net of all of this stuff. And it's just another thing to factor into that return on investment. So just be aware of that. All right. 401k plans. Now, you've heard me talking about these things for a while. And if we're looking at a 401k plan, so if you're a real estate broker and you want to invest in real estate or make loans, buy notes, that type of stuff, you want to self-direct, no matter what, even if you don't want to do that, I'm going to tell you have a solo 401k. Why have some other plan that doesn't allow you to do what you want to do? So really, for people who are self-employed without employees, I really don't see any downside of the 401k plans. And as I said, with the IRAs, we're sort of separating, we're segregating the more risky investments from the others, and anything that would constitute a prohibited transaction, we want to isolate the risk. The 401k plans, that's unnecessary because you're not going to impact other investments if you commit a prohibited transaction on one of your investments. So it's really a totally different thing. But you know, why do I like you know, the solo 401k? Well, I mean, as far as contributions in the IRA 401k world, they're going to maximize a high mid 50,000 range, typically like with a SEP IRA or a solo 401k. So your contributions are up there. We cannot roll. So when we're talking about creating self-directed accounts with IRAs, any IRA can be self-directed. If we want to create a solo 401k plan, we need to, you know, have we can't move Roth IRA money into a solo 401k plan, nor can we move a beneficiary. A beneficiary IRA is one that's been inherited. So we can have two of those two sources of funds going into the 401k plan. Now we can have you know, you hear the term like a backdoor Roth. You can roll your funds from traditional into Roth after they're in that plan. So, you know, I want to stress that you can have a 401k plan that has both a Roth component and traditional inside. We just can't migrate Roth IRA money into a 401k plan, nor can we move that beneficiary IRA money in there. As I said, the contribution limits are about the max short of a defined benefit plan. 401k plans, you don't have UBIT on leverage. No custodian, which is another nice thing that's there. You can invest in life insurance contracts, stock, and a sub S. The only restriction on investments is collectibles, like I said earlier. And then you can borrow from a 401k plan where you count with an IRA. You can borrow from your plan. Most plan, you know, documents include a loan provision in them. And you can borrow half what's in it to a max of $50,000, which is a pretty nice thing, which you don't have that ability with the IRAs. So is there a downside? I really don't see a downside. As far as reporting on these things, you know, we didn't talk about it, but with IRAs, if you've got a checkbook IRA, the only interaction you've got with the trust company annually is to provide them an annual valuation of all cash and assets that the IRA owns each year. And then if you get the RMD world, they're going to be, you know, cranking those numbers and helping you get that taken care of. If we're talking about 401k plans, if there's under $250,000 in the plan, there's no reporting. If there's more than $250,000 in the plan, then you've got a Form 5500 EZ, which a lot of our clients do themselves. You know, if you've got a CPA, good CPA, I'd just have the CPA do it annually for you. And other than that, there's very little in the way of cost keeping these things going. I mean, if we're looking at a checkbook IRA, for example, in comparison with a 401k plan, be aware that you're going to, with a checkbook IRA, you've got a custodial fee that you're going to be looking at, and that could be anywhere from, let's say, typically you're talking $400 or $500, $600 a year for the trust company. Maybe you can find it for less. There are very few out there that are going to be less than $4 these days. But you've got the trust company that you're going to be paying for. You're going to have a LLC that is cost dependent upon the state. Maybe if you're looking at California, you don't want it there because it's going to cost you almost $1,000 for an LLC there. Washington State might be 60, Colorado might be 40. It depends which states there. Oregon's 100. But typically when you're looking at the state of registration for the LLC, you're going to look at a couple different factors: where you live and whether the state of investment is going to have some domestic versus foreign investor tax type situation too. So you've just got to be aware of that. If you create the LLC, or we create the LLC in the state that you live, you could be the registered agent for it. If not, you're going to have a registered agent fee there too. So the checkbook IRA, you're typically looking at maybe $500, $700 a year to keep the thing going after you've created it. A 401k plan, you're just looking at annual, the amendments or restatements, which might be about $300 a year. So they really are very cost effective as far as keeping them going after you put them together. Few examples and that we're done. All right, we're out of time, but sorry, I've run over. I looked in a half hour ago. I thought, boy, I got all this time and now I'm over. So let's try to get through. I've got 3 examples and we're wrapped up. So this is a situation where people first came to us. They wanted to go buy a mobile home park, and this is a guy that had lots of apartments, and he was aware of the terrible T's, toilets, trash, tenants turnover, and didn't want to really deal with that. So his initial question on buying a mobile home park, that would have been fine, and it was going to make a great investment for him. Well, he decided he didn't want to do that. He decided he wanted to make investments in notes too. And this is an example. A lot of times people sort of dip their toe in the water too. When you're creating these counts, like I said earlier, it's not all or nothing. So this guy, first investment, this is back to the last recession. And he had a mortgage broker he did a lot of work with. And so he ended up making his first investment, was paying him 11% on this note. A property that had been a quarter, like 200, 250 pre-crash, had gotten down 70,000. He put a first on it, 50% loan to value, $35,000, paying 11%. That was the first investment. During the next few years, he moved over $2 million through us, and it was all with paper. And he just did great. I think the best investment that he had, the one that he wanted the guy to default. By the way, if you're doing this, probably nothing other than a first, and never make a loan for more than you'd be happy owning the asset for. But it was a wind plant down in the desert, and they needed about $1 million, paying them, I think it was 19%, and that million was a 10% LTV, and he was just cheering them on to default. So that was a nice example of passive investments, working on something, and it worked very well for him. And it was another example of dipping your toe in the water to get started. Another example of somebody just doing a basic thing, and this guy came to us and says, hey, I've got some money. I want to diversify my retirement account into hard assets. He needed more cash flow, so he wanted to buy the apartment building, thinking he was going to get the cash flow on it. Once again, I had to explain that that money is in the account until it's not. The only way he's getting the benefit is by taking distributions. As the funds build up in that IRA LLC, as you want to make a distribution, you're going to move the funds from the LLC back to the trust company and out. But this was at a point in time, pre-COVID, where we could actually get a custodial account, get the account set up to invest within a couple of weeks, and it worked great for him. This gentleman also, over time, I think one of the apartment buildings that he bought, he had a laundromat in, and he really liked the way the laundromat accented the income of the property. So he ended up deciding he wanted to go out and buy a laundromat too, and he did that. Well, keep in mind it worked out as a very good investment for him once again, but the retirement account had some tax exposure on that laundromat income, because that's a business, not necessarily just an investment. So, once again, be aware of when you're crossing a line from making an investment to creating a business. And again, flipping property is not an investment, it's a business, no matter what you want to say. So this is the last example, and if you've been to my class before, you've heard me talk about this one before, and it just really summarizes what is possible in this space. Now, we had an older retired couple come to us. They wanted to go out and make an investment in another mobile home RV park using his and her IRAs. And so our first response is, okay, well, we'll create a checkbook IRA, which allows them to make the investment buying the mobile home park. Well, as we talked with them, it became obvious that, well, they didn't want to just make an investment. They wanted to be the on-site managers, and they wanted to live there. So all of those things create prohibited transactions. So we had to shift gears from the checkbook IRA, which is a combination of a IRA and a limited liability company. We shifted gears into what's called a rollover business startup, which is a combination of a C corporation and a 401k plan. So we created the 401k plan. We moved both his and her retirement accounts into that 401k plan. We created the C corporation. The 401k bought into that C corporation. We do require our investors to also be shareholders at this point in time. And as that 401k plan funded the C corporation, they went and bought the park in the C corp. They got an investment, they got a job, and they got a place to live, all with that one transaction. And that's an extreme example of what is possible with retirement accounts when you're working with people that understand the process and what is possible. So when you're looking at these things, if you're the consumer and you're coming to us, I'm going to want to know what type of accounts you've got, what you want to do with this stuff, how old you are, and what your ultimate plans are. And that way we're going to create the investment vehicle that allows you to get where you want to be. We don't sell investments. We don't give investment advice. We are the conduit out of what you don't want into what you do want. We provide the investment vehicle. So I hope that this has helped you today to understand what is possible. This is sort of a final checklist to keep in mind anytime you're looking at things. Plan ahead. If you don't have the account, it's going to take 2 to 4 weeks. It's probably going to take closer to a month to get this thing set up. You can purchase all types of property with an IRA, SEP IRA, Roth IRA, 401k plan. You can purchase with family members and friends. You cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage. Negotiate from the deal's inception in the IRA or IRA LLC's name. Do not overextend. Plan on keeping a nice cushion of reserves. And lastly, real estate is a real investment. It's not an alternative investment. Thank you very much for joining me today. If you've got questions, please reach out to see more at 1031exchange.com. You can also, if you're once again a broker looking for CE, reach out to see more at 1031exchange.com. Thank you so much for joining us today. This packet will be sent out. It's available, and this presentation will be up on YouTube. If you've got questions on different things, or you're just wanting to learn more, or maybe you just can't fall asleep at night, please take a look at our YouTube channels. For 1031 information, just type in on YouTube Equity Advantage 1031. For IRAs, just type in IRA Advantage self-directed retirement accounts. You're going to find videos on all aspects of the processes, and I think you're going to really help yourself out by researching, learning this stuff sooner rather than later. And this is just a listing of our offerings. Thank you so much. Best of health for everyone. And I look forward to talking with you soon. David Moore, IRA Advantage, signing off. Bye-bye.